welcome to the War Hunt Investment Committee update. My name is Sam Hunt, and today I'm joined with Steve Grmth, an independent member of the War Hunt Investment Committee. We thought this was a good opportunity to sort of recap on our investment philosophy and maybe do a bit more of a deep dive into one of the factors that we focus on is value. So at a high level, really ultimately what we're trying to do when we construct portfolios is to give clients the greatest certainty around achieving the long-term returns that they need to meet their goals and objectives. And the way that we do this is by leveraging the latest academic research available to us and the empirical evidence. And what that research is really can be distilled down to is in three key points. One, we would expect a higher return from the equity market when compared to cash and fixed interest over the long term. The second factor that we really focus on is around small companies. Is there a premium available to us by tilting our portfolios towards smaller companies as opposed to larger companies? And the third factor that we really focus on is value. Are unloved companies by market capitalisation, will they outperform growth companies over the long term? So they're really like the three kind of major factors that we focus on. If we then look at how those historical returns have panned out, say from an Australian context, you can see from this graph here that 9 times out of 10 you would expect a higher return from equities over the long term, but there have been historical performance or underperformance from equities when compared to cash in the short term, and you can see that now in this graph where there's some negative returns based in the red. So looking at sort of the other premium that we focus on is around small cap and value, and you can see a very similar story that pans out, that there is over the historical context that you do get a better return from small companies, but there have been periods of underperformance when compared to large. And then looking at value, you can see the same sort of things that sort of panned out. So that's kind of looking back over quite an extensive period. But Steve, more recently, how's it kind of panned out for those premiums, or more specifically, how's it panned out for value?
Yeah, let's focus on value, Sam. It's been on the news a great deal. I'm sure some of the viewers will have picked up that value has had a really tough time.
I might stop you there. How would you define value?
Yeah, that's a really good question, actually, Sam. So lots of people define value in different ways. Good companies at a low price, you often hear. I think it's better that you have a systematic way of defining value. And by systematic, I mean you might choose to use a ratio, like the price of a company relative to its book value would be one way. But it could be price to earnings, it could be price to dividend yield. As long as it's a systemised way of defining value, I think that's a good way to look at it. So in other words, if you took the Australian stock market and sort of took the ratios of price to book value of every company, and you said, look, the ones with a really high price to book value, let's call those growth companies, and the ones with a low price to book value, let's call those value companies. In this chart, I'm putting value and growth stocks. Now, this is actually US data. Australian data is a little bit different. My first two bars are from 1928 right up to 2010, and it shows the bar on the left is value, and you see value's done better than growth. But have a look at basically the last 3 years. This is up to the middle of 2019, and you can see that growth stocks have had this phenomenal run beating value. And there's a lot of media, or there has been a lot of media about, is value dead, and has the world changed? It's never easy to have one reason why growth stocks have done better. It's certainly not something we can see in advance, because if we did, it'd be like guessing when equities are going to be negative and having the crystal ball. So we don't see that in advance, so we can only look back and see the reasons why. And one of the reasons why is in this chart, which we've had up before, Sam, but I just find it a fascinating chart. It's the Australian market over the last year and the US market over the last year. And the FANGs, that acronym for the Facebook, Apple, Amazon, Netflix and Google, and you can see the phenomenal performance of these companies. Now, of course, they're beneficiaries of the global pandemic and the work from home culture, but even before that, they had been on quite a run. In fact, they're up, over 100% for the year, so it's been quite amazing. They're all large growth companies. So you can see that in the last few years, when these companies have done so well, and they're such a dominant part of The US market, they're like 25% of the US market, and that market's about 55% of the global market. This group of stocks has got a huge influence, and in many ways, this explains retrospectively why growth has had such a phenomenal run. This is just an updated chart from the one I just showed, and it's got, let's look at the period from the start of January 2020 up until the end of September. And of course, being in the middle of a pandemic, it hasn't been a phenomenal year, but for value stocks, it's been just a terrible year. And you can see that they're highly negative, where growth stocks are kind of flat. But then, Sam, when we have a look at the last quarter, the quarter just passed, ending December 2020, you'll see a reversal. You'll see that value stocks now beating growth stocks. We don't expect value to be out of fashion forever. So the growth stocks have had a great run. They're great companies. Don't think that they won't keep going up. The question is, will they go up higher than a lot of these more unloved companies? And some people have called this the return to work trade. So the growth stocks did really well because they were the stay-at-home stocks, and now with the vaccine coming out, and well, in Australia anyway, life returning a little bit to some sense of normality, there's a little bit of a return to normal trade going on. Sam, I'll just finish. I'll just finish by saying, of course, the media are onto this, and there's all sorts of articles about there that, there's a rally going on in value stocks. So be careful of what you read in the media.
No, but just to that point, really, I mean, that sort of says it all about not trying to make short-term changes, that you're aligning your investment philosophy for the long term, and yes, there'll be periods of underperformance, but over the long term, you should get that outperformance. We don't know when or how. The fact that media is now talking about the fact that value is going to outperform, well, it already has. So that's yesterday's news. We don't know necessarily what's going to happen in the future, but we've been able to capture that upside in the portfolios.
That's a good point. And that's a good segue, Sam, into just looking one more time at the long-term returns. This is very similar to a graph Sam put up at the start of the presentation. Again, the blue bars going up are when value has won, and the red bars going down is when growth has won. And certainly the last few years, as we've pointed out here, growth has been the winner. But when you look at a chart like that, Sam, over that amount of time, and the fact, we're seeing value rise again, in a way, your expectation is that, look, these unloved stocks, these value stocks, I actually do expect that they'll come back and they will have a higher expected return. We just have to put up with periods where they don't outperform.
So the death of value has been sort of premature, you would say, Steve?
I think the death of value might be premature.
Terrific. Well, we might end the presentation there. Thank you for joining us, and we look forward to catching up again with you soon.
Thank you.